Welcome back, dividend and value investors. If you are new to this channel, welcome. I am European dividend growth investor. On this channel, I discuss everything dividend investing related and with a strong focus on stock analysis. Having said that, today I have prepared a video that is especially focused on you, because according to the channel statistics, there's an 80% chance that you are male and within the age category of 30 to 45 years old. That's why I would love to share 3 dividend stocks with you, which all sell products that real men need. But hey, let's get started. So the first dividend aristocrat that I would like to share with you is Stanley Black & Decker. This company has paid a dividend for 146 consecutive years, and they have increased their dividends each of the past 55 years, effectively increasing dividends since 1968. But let me also briefly introduce the company to you. So if you're not familiar with Stanley Black & Decker, they are mainly in the business of providing power tools, for instance for garden work or indoor work when you're making a renovation, and security. And they also do it for industrial clients. I believe that most of you know at least Black & Decker over in the Netherlands, as example, all the power drills that you can buy to put screws in the walls, but also Stanley in the States. And if we go, for instance, a little bit down here, you will see the brand of Sony Stanley Access Technologies, all related to security as well. So this is an iconic company, as you can see. I believe they have been founded in 1843. And if we go to their investor deck, what we can see here is that they have 2 business units. One is tools and outdoors, like I just mentioned to you, outdoor power equipment. Think also about the gardening, hand tools, storage and accessories, and power tools, but also the industrial part, and think about engineering fastening. Together, they make a revenue of 15.6 billion last year, of which only already 12.8 billion is coming from tools and outdoor. Now, if you think about it, right, in Europe, we have some exposure to their products, but the majority of their earnings and their revenues really come from the US, 60%, and only 17% from Europe, and then still 24 or 23% from the rest in the world. But what I really like is their long-term strategy, because they are aiming for 4.6% organic revenue growth, 10.12% total, because they are also aiming to do additive, mergers and acquisitions. This also leads to a financial performance that they are looking at for a 10 to 12% EPS growth. But what you can see here in the little numbers is that they are looking at 7 to 9% organically. The rest would come, for instance, from repurchasing stocks and adding new companies to their portfolio. What I also love, of course, as a dividend investor, which is really important for me, is continued dividend growth and a strong balance sheet. So, for me, this is really aligned with a long-term investor mindset, right? So as a dividend company, I'm actually really, based on this, sure or relatively sure that the management is just as committed to the dividend as what their predecessors were. If we then look at some things in the annual report that I really, really want to call out, because it's important if you want to invest in Stanley Black today, for instance, what you need to pay attention to. So in 2021, they have been building up inventory. They have been really bringing things forward. They spent almost 2 billion on inventory. So if you then look at the free cash flow, which is the cash from operating activities, 663 million minus 519 million, you would think, oh, there's almost no free cash flow and the dividend wouldn't be covered. So what is really important to know here just is that they've been building up their inventory and it costs a lot of working capital. So later they will need to spend less on inventory, right? So we would see, for instance, next year, the year after, much more increased free cash flow, and therefore I expect it to even out over the years. It's important when we later also look at the estimated free cash flow that we use for our discounted cash flow evaluation. Now, what I also want to let you know is that in the recent, quarterly earnings, and I believe this was from Q1, yes, the Q1, they already did a revenue guidance which is lower. So the full year guidance, at least for EPS, let's say like that, is now $7.20 to $8.30 compared to 10 it was before. That's one of the reasons why the share price went down so much at the time and why it came into value zone. Yeah, so this is important to know here. Free cash flow, approximately 1 to 1 billion. This was a big downgrade from the company itself due to the inflationary environment. So if we then go to the latest quarterly earnings release, you can see here as well, what I wanted to call out is that the gross profit currently is at a margin of 29%. It really dropped significantly from 37%. Look at this. Their net sales grew with 700 million. That's almost 20%. While their gross profit grew with almost 800 million. So from that point of view, all the additional net sales that they did has been equaled out. That's why we see a lower margin. So they're selling more at higher costs, but everything that they were selling more didn't earn them a single dollar. Not sure if these are fixed costs only or also variable costs. We can't go deep enough into that. But I think it's also important to know here in what state the company currently is. And this is probably because of inflationary pressure, price increases. So having said that, now that we know this company really well managed over the, let's say, the last 100 years, 55 years of dividend growth, came down with the share price. Is it the right time to buy this company right now? So if we go to Stanley Black & Decker, right, it's currently trading at $115. You can see that on general it looks good. A dividend yield of 2.77% with an annualized 5-year CAGR of 7.2%. What's worth calling out that their price to free cash flow is negative because the company went negative. Currently the company is not making any cash. If I would show that here, let's go quickly to the free cash flow here. You will see that the free cash flow went into minus 1 billion. That's what we're seeing here. I think it's temporarily. Of course, they need to catch up to inflation. So the upcoming quarterly report, which I believe is this week on Thursday, the 28th of July, you need to really look at this number. What is it doing with the free cash flow? If the company drops, let's say another 10%, then it becomes really attractive, I believe, because the company currently, on my opinion, has a fair value of $117. I'm using here 1,200 free cash flow from it. It's in the middle of their forecast for the entire year. I think their forecast was still too optimistic. But if you look at the 5 years average, I think it's a conservative estimate. If it then would grow with 6% annualized in the first 5 years and 3% thereafter at a discount rate of 10%, why 10%? This is what the general market performs over the long term. Hence, I want something equal, but also at a terminal multiple of 14. I believe that is fair value for a company like Stanley Black & Decker. In that case, it's trading now at fair value. What is though important still to know is if we look at the value creation metric, return on invested capital should always be, let's say, 5% or something like that, higher than the weighted average cost of capital, which effectively means is like it should be more profitable than money costs to borrow from either shareholders or from the banks, right? It's not looking so good already over the last 5-6 years, so you could argue that the company is not really creating value for their shareholders. In other words, you might actually apply a bigger margin of safety, maybe even minus 20%. In that case, you would probably more like aiming at the low $90, which would give you approximately a 3.25% yield. I would definitely consider, if all being equal, no worse performance in the earnings, let's say, to start initiating a position at that moment in time. So guys, this is a typical man stock, right? Because we all love their tools to do the home renovation and everything and working in the garden. So in my opinion, this is the first one. You gotta know what you own. You need to have affinity. I definitely have some affinity with this product. Oh guys, by the way, I just want to let you know, I got a lot of times questions from you guys if they could do something for me or not, or if they could contribute a little bit for all the time that I put in. Look, guys, lately I discovered buymeacoffee.com. So if you want to support me, just buy me a coffee. You put a smile on my face. And that's why I also want to call out some of my biggest supporters already so far. Boris, Krzysztof, Maarten, 1 Million Journey, also Rafa, Eloy Snowball, and Collector of the Dividends. Thank you so much. You guys are really, really helping me. And in return, I will make definitely another movie on one of the earnings reports for this week. Thanks, guys. Really appreciate it. So the next company then that I would really like to discuss with you is Snap-on. Snap-on has a dividend growth track record, consecutive growth of 12 years. This is really important. At a 5-year dividend growth rate of 14.9%, which is really high. Currently a payout ratio, according to Seeking Alpha, 35%, but a dividend yield of 2.66%, slightly lower than Stanley Black & Decker. Now, what I find really important here that I wanted to call out, it says only 12 years, right? But that's because in 2009, the dividend was flat compared to 2008, both $1.20. I know the American dividend aristocrats are then not considered an aristocrat. But if you think about this, they did something really prudent because the housing market was collapsing in that time. So I think, in my opinion, it's a bit more Euro style how I look at it. It's totally fine in one of the biggest financial crises we've ever seen, at least definitely for me in my own lifetime, that a company freezes the dividend. They didn't cut it, so if I would have been living off dividends, my income would have been secured. But after that, you all the way need to go to 1996 to find still a dubious dividend cut, because what they did there was a stock split. So that's why they paid an additional 50 cents out. Otherwise, without that, it wouldn't have been a dividend cut. And then we would need to go back again all the time. We will see that in 1993, they froze the dividend, and in 1994, 1995. So it was a difficult period there, right? But still frozen. Before that, it was still growing its dividend. Here again, $1 because of a stock split. So you could argue, if you look at this, that the dividend hasn't been cut as far as the dividend history on the page goes, which is all the way back to 1972. I think it's important because we are sometimes too picky on the 12 years number and therefore saying it's not a dividend aristocrat. In my opinion, this company just applies to being a dividend aristocrat. If we look at this company then, still a small introduction. Like Stanley Black & Decker, it's really focused on people that like to fix things, but it becomes already a bit more industrial here, or at least professional, because you can also see a really car repairman, they use it in their shops, right? Now, what I also would like to show here is like how some of their products look like if you're not familiar with it. Here you see some brands that you might be familiar with if you have spent some time in the Americas as an example. But what I really like here, for instance, is that you can see the business units as well. It's really well diversified. Something more than a third is on the tools group. Then we have the repair systems, 29%. The industrial group, another 27%. And financial services, 7%. And usually financial services are typically really profitable. Now, also here, I would like to show you again the working capital impact, because if we look at the 10K, so the annual report from last year, you can see again that their operating cash flow was lower by $50 million, again, because of small inventory buildup. If we then go to the last quarterly report, you can see again, inflation, inventory buildup, 123 million. So in this case, it also means a lower free cash flow compared to last year. Again, this is just the time we live in now. All these companies are being hit with this. Inventory itself for me is always good because it will come back later. But also inventory might be higher because it just costs more now to buy stuff, to import stuff. So if they can't, if they can't sell more, if they don't have pricing power, all the costs will be at the cost of Snap-on. If they are able to pass on some of the costs to the customer, then we should be fine. But what you can also see is that their accounts receivable went up. This is effectively people that still need to pay money to Snap-on, right? That's why it's just down. So similar story to Stanley Black & Decker, I would say, but let's have a look at their performance then. So if we look at that, Snap-on Incorporated, currently trading at $213, right? And this is what I love, because this whole column is almost on green. You get a dividend yield of 2.66% and free cash flow payout, even though it was lower, an annualized one of 45% and a price to earnings of 13. For me, this means that this company is really in a good situation, performing well, even with an A2 credit rating, hardly any debt compared to equity, and a 9% almost value creation. So this is really good. Oh, and by the way, have I mentioned even the 17.4% dividend growth over the last 5 years? Amazing. Now, what I'm doing here, I'm using a 770 free cash flow annualized. Yeah, and I think this is fair over the last 5 years if we look at it. If I only take a 5% growth and the 3% thereafter, but a terminal multiple of 16 for a company with such a balance sheet and such a track record, I believe that the fair value of the company is currently around $229 and it's trading currently at $213, which means it's currently 7% undervalued. So there's nothing to look forward for at this moment in time. We have already a really good state of the business and the affairs of the company. Hence, I find it really attractive. If it would drop to, for instance, 275 or 280, I might personally consider opening a position. So guys, this was the second stock that I believe real men should like, definitely based on the products. So the third and last company then is Illinois Toolworks. And here I wanted to really start with some porn chart. Look at that, guys. From 1989 onwards, let's say 8 cents per share annualized, all the way to now 4.72. I mean, guys, this is what we're doing it for, right? Imagine that you started 30 years ago, let's say in the early 90s with dividend investing in this company. I mean, you would be filthy wealthy just from this stock alone if you would have put 10,000 in it, right? Now it's easy to say 30 years later that this company would perform so well. We would have probably not expected it. Of course, we have also the globalization part of this so that they could sell abroad, not just in the US. All part of the investing story, of course. But guys, these guys are really, really on it. Now, if you don't know what Illinois Toolworks does, here it is a bit different than, for instance, Stanley Black & Decker. From Stanley Black & Decker, it was really a lot also in the consumer space. Then we saw with Snap-on, it becomes already a bit 50-50. But now with Illinois Toolworks, we're really more into the professional business. So you can see here, the most is earned via automotive, 14% construction, food equipment 14%, polymers and fluids. Well-diversified company with a 14.5 billion in revenue, which is actually not so different from what we saw with Snap-on and what we saw with Stanley Black & Decker, right? A margin of 24%, so it's a little bit lower than we saw just with Snap-on. So if we then look at their performance targets, their strategy, what I like here is again that it's really well aligned with us as long-term investors, 3 to 5% organic growth, right? We saw the Stanley Black & Decker has a little bit higher growth numbers there. They're looking at a 7 to 10% EPS growth, which is really good, and the 50% dividend payout ratio. But generally, I would say what you can see also from their history, they have, I believe, 59 years of dividend growth. They're really committed to the dividend, guys. So if we look at their performance from a financial point of view, what I wanted to call out here is that their debt profile looks different. Here you can see that they have almost 7 billion debt. They, by the way, paid off quite a bit since last year, which is good, guys. But they did it also via share repurchases because their equity is 3.6 billion. However, what you can see here is they have been buying back shares for around 20 billion. If they wouldn't have done this, their debt profile would have looked much better from that point of view. But I always look at it like that. It's nice that their equity goes down, but the equity is really what I own as a shareholder, not the debt. And they've been paying it back. So if they would like to give me back the equity, they would need to issue everything. And this would also really impact the share price. Hence, I don't look at it as some other financial analysts where they say like, it's buybacks. No, for me, you don't get a free lunch. We will never get a free lunch. We are always screwed as retail investors when it comes to those moments in time. So I really look into this. If I then also look at the free cash flow quickly, the free cash flow here, what we can also see last year, it was still quite good, right? From a cash provided by operating activities. You could also see here again the inventory build up, or at least paying more for inventory. So this is where inflation hits the fan. But still, I would say a relatively good free cash flow here. If we then look at the last quarterly earnings report from March 31, you can see still inventory went up, but also the trade receivables went up. So they still are waiting for some money for customers to pay. And that's why you saw that operating cash flow was almost half of this. And this has, of course, again, an impact on the free cash flow. So guys, if we then look at my dashboard here, right? The company is currently trading at $191. As you can see, an awesome dividend growth track record. But the payout has been slightly growing over the years and currently at 78%, mainly because free cash flow went down, as you can see here on the trailing 12 months number. And I believe the real cash flow at the end of the year will look more ugly than it is today. It has a dividend yield of 2.55%, 59 years of dividend growth. The last 5 years, the dividend growth annualized of 15%, which is really strong. EPS payout still good at the 57%. What I don't like is really the valuation. I mean, we just saw a company with Snap-on trading for 13 PE. This one is trading at a 22 PE and a 33 to cash flow. What is really impressive though is the return on invested capital and the weighted average cost of capital, 15% value creation. I've shown the debt to equity already and a credit rating of A2, because if you take the buybacks out of it, their balance sheet would look really good. Now, if I then look at, for instance, a 2.2 billion, because that's the 5-year average of free cash flow, and expect that to grow with 6%, thereafter with 3%, at a terminal multiple of 14 and discount rate of 10%, I believe the company is actually only worth $108. This shows that this company is heavily overvalued, and that's why I'm far from even considering entering a position in this company. It's currently trading at 2.55%. For me, it doesn't even substitute the amount of difference in value to even consider it. So that's why I believe it's also, again, an awesome company for real men, for guys like us, but not to own at these prices. That's the value investor in me that would stop it, and the dividend yield is not compensating enough for it. Having said that, guys, I've shown you now 3 of these stocks for real men. Let's put them together on an overview, because you might get lost a little bit. So guys, if we put these 3 stocks together, right? If you look at the criteria, dividend yield more than 3.25%, none of them, but still good enough. Stanley, Black & Decker is clearly the winner. 5-year dividend growth more than 6%. All of them tick the boxes. Snap-on the best here. Also at the medium yield. Keep that in mind. Dividend growth, I put it 25 years for Snap-on because of what they did in the 90s. And I ignore the freeze that they did in 2009. Free cash flow, best payout ratio goes to Snap-on. Debt to equity, again, the winner is Snap-on. And fair value, at least Snap-on seems to be the most undervalued. So for me, this is the clear winner. It will be high on my watch list, Snap-on, going forward. I mentioned already like 2 or 3 videos a little bit back. If this hits my 2.75 or 2.9 or something like that, consider me really entering a position in this company. I'm really, really impressed with Snap-on. Guys, this was it. If you're new to investing and you want to start yourself as well, check the left for a video which explains a little bit the basics of dividend investing, and check the video on the right where you can grab a free portfolio template. Guys, thank you so much for staying with me until now. Have a great week ahead.